Welcome back. Today we're looking at an analysis report on BURU, ticker BURU, arguing for a huge turnaround.
An explosive one, I think it says.
Right, and its strongest point, right out of the gate, is how it uses the NYSE compliance lifeline to just, remove that primary fear factor for investors.
It's a great hook.
It is. So let's build on that and dive right into the first big structural issue. To really make that explosion claim credible, the analysis has to fully quantify how the share dilution and cash burn affect that short-term price target.
Okay, so this is about integrating the bull and bear case.
Exactly. The weakness here is a classic misstep I see in these kinds of reports. It identifies the risks, the 433 million shares, the cash burn.
Puts them in the bear trap section.
Yes, and then it just leaves them there. They're quarantined. It's like a disclosure, not an active headwind that the company has to overcome to hit that 50% target, that 30 cents.
Right. By separating them, the argument feels, a bit intellectually incomplete.
That's the word. It doesn't show how the good news, the catalysts, are actually strong enough to absorb all that inevitable selling pressure from the dilution.
I completely agree. That separation is the core problem. It's too easy for a writer to just list the existential risks and then, pivot to the good news without showing how they interact. Any savvy reader, especially someone looking at a deep value play, sees 433 million shares and just immediately applies their own discount to that target price.
Of course they do.
So if the analysis doesn't give them a story of neutralization, they're just going to assume that 30-cent target gets wiped out by profit-taking instantly.
Precisely. We have to close that credibility gap. So the suggestion for improvement is to physically integrate the dilution factor directly into the technicals.
Into the chart crime section, as the analysis calls it.
Yes, weave it right in there. The report needs to shift its focus from here's a risk to here is why this risk is now basically impotent.
Okay.
It needs to explain why the new cash flow is powerful enough to neutralize that selling pressure, both from long-term dilution and short-term profit takers at that 30-cent resistance level.
That makes sense. You're not just hoping for the best. You're arguing that the structure is fundamentally changed.
You're proving the thesis is sound, not just optimistic.
So let's talk concrete examples. How do you do that without getting bogged down in, complex financial modeling that might lose the reader?
It's more about the narrative weight than academic precision. A great example would be to show how the security from that new €2 million Techne funding actually changes the daily trade volume profile.
Ah, I see. So you explicitly link the financial lifeline to the chart breakdown.
You connect the money to the market action. Instead of just saying the cash is there, you defined its measurable impact.
You could, for instance, calculate the average daily trading value over the last, say, 90 days.
Yeah.
And then state exactly how many days of that average volume the new Technicash actually supports. That quantifies the buffer.
Exactly. And by doing that, the 19 to 20 cent floor on the chart starts to feel fundamentally engineered by new capital.
Not just a random technical pattern.
Right. It gives institutional gravity to what otherwise looks like low-volume consolidation. You're measuring the catalyst against the debt, and that gives confidence that 30 cents is actually achievable. Okay, that integration of the dilution risk is, I think, job number one for credibility.
It's essential.
Now, speaking of fixes, let's talk about the main narrative driver, that pivot to defense.
The explosive part of the thesis.
Yes, and right now, that engine is kind of burning too many different types of fuel at once. It's a bit messy. We need to refine the narrative to forge a much more immediate and compelling link between the new funding and actual visible defense technology.
The message has to feel urgent.
That's it. So the weakness is that the pivot to defense section blends, 4 different things? You've got the Liacon acquisition in Italy, the Techne funding, the Maddox Defense Alliance, and then this old NASA award.
The Blue Plum Award.
Right. And mixing all that together, it just dilutes the core message, which is this is no longer just a welding company.
I agree. The Liacon acquisition, for example, it's great for Europe, but it can feel like a distraction from the pure defense tech angle unless you explicitly tie it to a defense bottleneck.
And when a turnaround story is this aggressive, that focus needs to be absolutely razor sharp.
Completely. And why are we bringing up a historical NASA contract? That context might actually undermine the urgency of the current pivot.
It could, yeah. It almost feels like the company is grasping at past glories instead of executing a new plan.
The whole thesis is built on an imminent explosion, right? So the catalysts have to feel recent and forward-looking. I'm wondering if the causality is a little fuzzy.
It is.
So the suggestion has to be creating a clearer, more direct chain of causality for this whole defense tech thesis.
That is spot on. The report has to prioritize the current and imminent outcomes. What are Techna and Maddox doing for the company right now?
Not last year, not 5 years ago, today.
Right. What is that initial $2.1 million funding tranche enabling specifically in the defense context? Is it a prototype? Is it the first pilot contracts? We need milestones with a timeline that feels like weeks, not quarters.
Okay, so for concrete examples, we could restructure that whole section.
How so?
Start with the new partnerships and the Techne funding as the immediate fuel. Then frame the Lyocon acquisition, the Italian job, as a way to rapidly accelerate defense engineering talent for the European defense market.
I like that. So it's not just global expansion.
No, it becomes an integrated, necessary component of the defense pivot. It directly feeds the Maddox alliance. It has a purpose in the story.
It's all part of the same thrust.
Exactly. And you have to remove or at least subordinate that NASA award unless it has a direct, functional link to the current drone or SAS push. If it doesn't feed the immediate narrative, it belongs in a footnote.
That really sharpens the so what factor. The reader walks away knowing why this specific moment is the tipping point.
They understand the company is fundamentally different today because of what Techne and Maddox are delivering.
Excellent. Okay, so we've tackled dilution and sharpened the narrative. Now for maybe the most important fix of all, the overall structure of the argument. The structural flow of the analysis has to be adjusted so that the fundamental catalysts are what validate the technical analysis, not the other way around.
So fundamentals have to lead the technicals?
In a turnaround story like this? Absolutely. The weakness right now is that the report uses technical indicators, RSI, oversold, the double bottom at 19 cents, to justify the timing of the explosion.
Which is pretty standard for a high-energy trading report.
It is, but for a deep value story, where the company's survival was just on the line, the fundamental reasons for that stock consolidating are so much more powerful than the chart pattern itself.
Right now, they feel like two separate data points. Here's the chart, and over here is some news.
Exactly. They feel detached.
But hang on, isn't there a risk here? If you lead with the heavy fundamentals, you might lose the trading audience that's just skimming for an entry point on a chart.
That's the tricky balance, isn't it?
How do you layer in that fundamental complexity without killing the urgency?
That tension, blending the structural insight with the tactical timing, is what makes an analysis great. And the suggestion is to strengthen the link between the financial lifeline and that technical support floor.
Make them cause and effect?
Precisely. The NYSE compliance extension and the funding were very recent, very material events, so the analysis should argue that these fundamentals are the reason the stock bounced off 19 cents repeatedly.
So the news isn't just a catalyst for the future.
No, it's the anchor that stopped the downward trend. It's the justification for the technical floor.
That is the critical distinction, you're right. For a stock like BRUO, the market needed to know it wasn't just going to be delisted before any of these catalysts could even happen. So the argument is that the bounce isn't some coincidence. It's a high-volume reaction to life-saving news.
Yes. So for a concrete fix, you'd introduce the NYSE compliance plan and the Techne funding before you even get to the technical analysis section.
You frame them as structural stabilizers right up front.
Exactly. Then when you discuss that 19 to 20 cent support floor, you state explicitly that this isn't just a technical bounce. This is the market pricing in two things. One, the removal of the delisting threat, and two, the validation from institutional money through the Techne deal.
And that provides a much stronger data-supported narrative for why that consolidation zone is a real floor.
Which, in turn, makes the 30-cent price target way more believable.
It elevates the whole piece from just a trading summary into a genuine deep value assessment.
It gives the analysis the gravity it needs to support that aggressive claim. Okay, let's wrap up this critique on the BRUR analysis report. We've really focused on making that explosive claim feel robust and urgent.
Grounding it in reality.
Our three main points of feedback are, first, integrate that dilution risk directly into the price movement argument. Show why the catalysts can actually neutralize that share overhang.
You have to address the biggest risk head-on.
Second, sharpen the defense tech narrative. Create a clear, urgent chain of causality from the new funding to imminent defense-specific results.
Cut the noise, focus the message.
And third, structurally anchor the technical analysis, specifically that critical 20-cent support floor. Anchor it in the new fundamental lifelines, the NYSE compliance, and the Techne funding.
This analysis report has identified a huge opportunity. The high-energy tone is absolutely perfect for the story being told here.
It is.
We really want to see this succeed. The next step is tough, but it's vital. Take those big structural risks and make them work for the bullish thesis.